Today, I want to give you the exact 3-step escape plan. Now, at the end, I'm going to give you the #1 strategy that the rich are using to escape this crisis so you can too. So let's go. Let's use Bitcoin, one of my favorite assets to do this with, because it's compounding at an annual rate of about 50%. It's about 85% in the last 5 years, about 60% in the last 3 years, but let's not use 60%, let's just use 30.
Inflation doesn't take dollars out of your bank account directly. It just makes those dollars worth less over time. The government prints money, expands the money supply, and your paycheck doesn't stretch as far. In the US, the official inflation number, measured by the CPI, hovers around 2.53%, but the real monetary debasement rate is closer to 7% annually. That means every year your wealth is losing value whether you realize it or not.
Let me give you the framework now. So this is the escape the plan framework. We'll call it escaping the rat race because of cash flow. He calls it escaping the rat race. So #1, we must defend our dollars. I'm going to break all this down for you. We have to defend our dollars, #1. #2, we have to escape the rat race. That's the first part of the game. And then #3, we can create our own. I'll come back to that in a second. Okay, let's break these down for you one by one so you can get this dialed in. Step #1, we must defend. We have to defend our income and we have to defend our wealth. What are we defending them against? We're defending them against the in-game mechanics that steal it from us, which are #1, inflation, and #2, taxes. All right? So we have to protect our income and our wealth from those things. What am I talking about? Well, #1, taxes. The best way to lose most of your money is taxes. This is the top tax rates around the world, depending on where you're at. So in the United States, it's a 37% top federal tax rate. Pretty high. Not as bad as some of the rest of the world. For example, Canada, 53%. Denmark, 56%. Austria, 50%. The UK, 45%. And Australia, 45%. So depending on where you're at in the world, about half, let's just call it about half of your money goes to taxes. Well, I need to defend my wealth against taxes for sure, because half's going to get lost there. I also have to defend it against inflation, because even after you pay your taxes, whatever you have left, the government continues to steal it from you by stealing the purchasing power by printing more money. Here's just the United States money supply right here. You can see these trend lines of how they continue to increase the rate at which they're debasing the currency. Look at these lines keep getting faster and faster. Since 2010, you've been losing about 7% of your money per year to debasement. So they tell you the CPI, consumer price inflation, is about 3%. The Fed's got a target of 2%, whatever. The real number is the rate of monetary debasement. It's about 7%. So I have to protect it against that. Now, we also have to understand how inflation really affects us. Again, it doesn't take the dollars out of your bank account. What it does is it takes away the purchasing power. So here we have a chart. This is what your income looks like on paper. I used to make $8 an hour, and I make $15 an hour. Great. But when you adjust it for inflation, this is what it looks like. The real rate of your wages going up, it's barely moving. Not compared to the rate of everything else going up. It's not keeping up with the rate of homes going up and state going up. And then if you put that into the S&P 500 every 2 weeks, and when your paycheck goes into your 401k, your IRA, whatever it is just keeping up. The S&P 500 is just barely keeping up with the rate of monetary expansion. And so we have to protect our income and our wealth from taxes and from inflation. All right? That's what we have to do. We have to defend it from that. Then, step 2. Once we've figured out a way to do that, we have to escape. Escape what? Escape the rat race. So how do we do that? Well, #1, we need to buy assets, right? That's the difference between the two different mindsets. The consumer doesn't buy assets that go up in value. The consumer buys things that go down, liabilities that lose value. What the investor mindset does is they buy assets that go up faster than the rate that they're losing, all right? So we want to buy assets, but we need to rethink what income is. This is a key piece I want to hit on. What is income? Let's think through this in like a first principles level. Now, most of us think of something like yield. So for example, I have to buy something that yield. Like Warren Buffett says, I wouldn't buy gold or I wouldn't buy Bitcoin because there's no yield, right? And so there's an entire crypto asset category called DeFi around getting yield from crypto assets, right? Or I have to buy a dividend paying stock, or I have to buy real estate because I need that yield. But let's just think through this for a second, all right? So If I buy a dividend paying stock, so I'm gonna buy an IBM or AT&T because I want it to give me a yield, I want it to give me a dividend, I want it to give me monthly income. What we can see is since 2010, the average yield, the average percentage of dividend paying stocks has fallen off of a cliff. It's gone from about 2% yield down to about 1.5% yield. So that's not really enough. I'm not really gonna make a lot of money there. I would have to have an enormous amount of money to get by there. We can see that this is a big problem because, of course, the baby boomers are the largest segment of the population. Anybody that doesn't want to work needs fixed income, but we save for retirement one day, and then hopefully that retirement, that savings, can give us that yield. So we can see that this is the entire fixed income market. We know it's about $150 trillion are sitting in this fixed income. Corporate bonds, right here, 25% of it. Government bonds, like US Treasuries, right here, it's a big chunk of it, and all these other little things that are in there. But I want you to rethink of what yield is for a second. So this is Investopedia and what they're telling us yield is. So they're saying that yield is the earnings generated and realized, so not unrealized, but actual earnings that are generated or realized, just to say, on an investment over a particular period of time. What time? A particular. So for example, if I bought a house, a rental property, and it gave me $100 a month, is that yield? Is that income? Sure, right? I bought the house, let's say I bought a $100,000 house, it gives me $100 a month, that's yield, that's income, $100 a month. What if I bought a $100,000 house, it didn't give me $100 a month, but in a year from now I sold it for $200,000? Is that income? Is that yield? Certainly. It's just a different period of time. Instead of monthly, it's now annually. What if I bought it for $100,000 and 3 years later sold it for $500,000? Is that income? Is that yield? Yes, it is. And the reason why I want to point that out is because the way that we win the game is by thinking differently and approaching differently. So instead of going, well, I need to get into fixed income, I need to put my money into treasuries at 4% or dividend paying stocks at 2%, we can start to think about assets differently. We can start to think that capital gains, meaning I bought the house for 100, sold it for 500, could lead to where I want to go. Now, this opens up the door for us on ways to get the income. So remember, we have to defend our income against taxes and inflation. That's the very first part. To defend against inflation, we have to beat at least 7%. We really need to beat 10%. So then, what assets can do that? We can see Bitcoin can do that. It's averaged 80%. We can see the NASDAQ 100 can do that. It's averaged about 17%. This is for the last 10 years, by the way. We can see the S&P 500 has averaged 14%. The Russell 2000's right at 10%. Most of these other assets, they're not working. We can see gold and REITs are just around the borderline of where they might keep up with the cost of debasement. All right, so now we have more options. I can go into S&P 500, I can go into Bitcoin, etc. All right.
Take Bitcoin, compounding at even a conservative 30% annually. Over 10, 15, 20 years, the growth curve goes parabolic. If you sell early, you miss out on the exponential upside. But if you borrow modestly against it, you can enjoy liquidity while still capturing those compounding gains. This is the strategy of the ultra-wealthy. They don't cash out. They borrow, leverage, and hold.
So now we have to think this a little bit differently. Let's go to step number 3. Now we can become our own bank. What do banks do? They hold assets, they provide loans, they make the difference. So here's what we want to do. As the bank, we want to hold the assets. So you hear Michael Saylor say, you never sell your Bitcoin. You hear me say, you never sell your Bitcoin. But you never really want to sell any of your assets. Why? Because the assets are compounding in time. It's something we call CAGR, compounded annual growth rate, which means over time they start doubling. So we want to hold the assets that are going up in value. We don't want to sell them. Why don't we want to sell them? Well, because if I sell them, whoosh, half of it goes to taxes. We have to defend against taxes. So I hold the assets to defend against inflation, but I don't sell the assets because I want to defend against taxes. Okay, well then how do I fund my lifestyle? You said that I'm supposed to buy assets to give me income. That's what you said. So I thought I had to buy dividend stocks or US Treasuries or real estate. No, it's not what I said. We can harvest this appreciation using debt. All right? So we have two options. One, we bought an asset down here. Well, let's say that we bought an asset for 1, and the asset over time has gone 2, 5, and 10. So it's defending our income against inflation, and it's going up in value. But if I sell this asset right here, half of this is going to go to taxes. I only end up with this much. But even worse than that, I no longer have the asset to continue going up in time. And because of the law of compounding, those last doubles are where it makes all its money. We want to hold the asset. So what we do instead is we buy an asset for 1, we hold it 2, 5, and 10, and instead of selling the asset, paying tax and no longer having it anymore, we can take just this little bit right here and we can harvest that appreciation using debt. How do we do that? We borrow against the asset. So for example, if this is stock, let's say it's a Mag 7 stock, Tesla, Apple, Google, it's in my stockbroker account, I could message my stockbroker account and they'll give me a loan against my assets in there. If I have assets in a 401k, a lot of your 401ks will give you a loan against it. If I have a piece of real estate, I can refinance it. I can do a home equity line of credit. If I have Bitcoin, I can borrow against it. And so what I do is I borrow against a little bit of it, 10% of it, and I harvest the 10% of appreciation. Why? Again, because I defend against the taxes. I don't want to sell it, and I need to defend against the inflation by holding the asset. So I'm arbitraging the spread. Does that make sense? Let me give you a couple examples of how this works. Let's use Bitcoin, one of my favorite assets to do this with because it's compounding at an annual rate of about 50%. It's about 85% in the last 5 years, about 60% in the last 3 years, but let's not use 60%, let's just use 30. So let's use a hypothetical example here, and let's say that this blue line is Bitcoin going up at 30% a year, about half of what it's doing right now. What you can see at year 2, at year 5, and year 7, it's starting to separate itself. But you see what the law of compounding does. Year 10, year 12, year 15, year 20, look at the difference of the growth. Now, what I'm doing all along here, this orange dotted line, is the debt that I'm putting on it. I'm harvesting some appreciation off of the top over time. So I still have the asset going up at the full rate, but my debt is also growing. So you can see this orange line is also going up, but just barely, if we can zoom in on that for the audience to see. The amount of debt is growing way slower than the total valuation of the assets. And so we want to, if we sold the asset here, we miss out on all this growth, and we lost half of that to taxes right off the bat. Versus if I harvest a little bit of debt here, I could continue enjoying the asset appreciation all the way up, and it grows way faster than the rate of my debt.
This framework is how you break free from a system designed to keep you working until you die. The rat race doesn't end when you retire. It ends when you master these principles and start playing the game like the wealthy do. The sooner you start, the faster compounding begins working in your favor. If you found this valuable, make sure to hit like, subscribe, and share this with someone who's still running on that treadmill. Because escaping the rat race isn't about luck, it's about strategy.